Welcome to another episode of the Takeaways podcast. On today's episode, I'm with Zach George, who is a co-founder and the managing partner at Launch Africa, which happens to be one of the most prominent early-stage VC firms in Africa. On today's episode, we'll be talking about the challenges and the opportunities that are present in Africa at the early stage. And I'm happy to have you here, Zach, man. How are you?
Yeah, good. Can't complain. It's a busy time for all of us as we are managing two funds. Our first fund, which is in its harvest period, and our second fund, which is towards the end of its capital raising period and just over the halfway mark in its deployment cycle. So it's a busy time, but a good time nonetheless. Yeah.
Let's start at the beginning, right? Before you came into VC in Africa, you were an investment banker in the US. How did your career go from there to now, being a VC in Africa?
Yeah, I was an investment banker for several years at Lehman Brothers and Barclays in New York, doing everything from IPOs to capital markets to M&A. I came to South Africa in 2010, and I saw a lot of. I came here for the World Cup in 2010, and I saw a lot of similarities between the tech ecosystems in places like India, which was going through its startup tech sort of revolution in the early 2010s, and followed very closely by two other ecosystems, Southeast Asia, so Indonesia, Singapore, etc., and then Brazil, Mexico, and sort of in Latin America. And I just figured that, sub-Saharan Africa was still very much untouched from a tech and startup perspective. So I started coming here and consult. I also realized how powerful the banks and insurance companies and telcos were in Africa. So I realized that if you could start startup innovation by targeting the corporates first and figuring out how startups could solve problems for large insurers, telcos, and banks, that was a better way to sort of kickstart innovation by starting with the end in sight. So I built two accelerators, in fact, more than three, but two significant ones over the course of my career then. I built something called Tech Lab Africa, which was an accelerator for Barclays. Barclays at the time owned 2/3 of ABSA in South Africa. So we built an internal innovation accelerator for Barclays that was sold to Techstars. And then we did some work for the Alan Gray Orbis Foundation on an accelerator for them. But then the real big moment was in 2016 when we were asked to launch the Africa operations of Startup Bootcamp. Startup Bootcamp is one of the biggest accelerators in Europe, and we were asked to run Startup Bootcamp in Africa, which became the first multi-corporate backed accelerator on the African continent. We had the likes of Old Mutual, Nedbank, Woolworths, PwC, MTN, several large corporates that worked with founders to create MVPs and then do POCs and pilots, and then eventually raise capital on demo day. So we had 3 cohorts, 10 startups per cohort, 3 cohorts a year, 2017 through 2019. And one of our biggest success stories was Kuda, the digital bank in Nigeria, and that propelled us. They're now more than a $500 million valuation company, so we've done really well on that. And that's now propelled us to get more accelerators into the African tech ecosystem. So after Startup Bootcamp, we had Plug and Play coming to Africa, we had Antler coming to Africa, we had Founders Factory coming to Africa. So yeah, that was sort of the initial, stepping stone towards what would then become Launch Africa. Launch Africa was then launched in 2019 between myself and my partner Junaid, who was at the time the head of venture capital at Nedbank. And Launch Africa was essentially a post-accelerator pre-Series A fund. So we got all our best deals from the big accelerators across Africa. And because I was running accelerators, it was an easy sort of transition. Yeah, and then Launch Africa launched in 2020 in the summer. And we raised quite a bit of money. We raised $36.2 million from more than 200 investors across the world. without taking a single dollar from DFIs. So yeah, even today, we are one of the top funds in Africa that has raised collectively more than $50 million without a single dollar from a DFI, which is quite significant. And then we've invested that in Fund 1. We invested in 133 companies. And Fund 1 is now entering its 6th year of operations. We've already had some exits. And Fund 2 is halfway through its investment cycle. We've raised about $25 million, and we're targeting a final close of $50 million. So that's where...
I want to speak more, on the role of like accelerators in trying to build the venture scalable startups in Africa. You mentioned your work, like a startup bootcamp and net, like a Techstars, right? Do you think that the corporates are doing a lot of work like in supporting these accelerators as they did back in 2018, 2019? And then the follow-up question is that what role do like accelerators play in like really driving the building of startups that are going to scale?
Yeah, I mean, so what I was saying earlier is that corporates are still very much involved in accelerators. Corporates sponsor a lot of accelerators. The reason why corporates back accelerators is not to invest in companies. Corporates find it quite hard to invest in companies directly because of, the need to justify the benefit to the corporate from an equity perspective. There's, corporates cannot typically take small stakes in companies. When I say small, I mean typically single digit or double digit stakes in company, early sort of like early teens, right? Because the amount of accounting, legal, and compliance requirements can often be more than the actual cost of the investment. So corporates are able to do commercial agreements with startups a lot easier and pilots than do equity investments. So corporates find it easier to do two things: to invest in later stage startups and have a majority stake, so 50 plus 1% stake, or they put money into accelerators as sponsors, and they get a first look at the top companies coming out of accelerators without having to make equity investment. The corporates are still involved, but it tends to be more either from a marketing, product development, or sometimes social responsibility budget. But when it comes to actually investing in startups, corporates in Africa tend to be a bit reticent a bit. Now, a lot of corporates are now running their own accelerators, which is more sort of a call for applications to solve problems that the corporate cannot solve themselves. And then the winners of these contests or programs then get to be suppliers to that corporate, right? And a few corporates in Africa go one step further, and they develop CVCs, which is a corporate venture capital unit. So, for example, you may recall Old Mutual had Next 176. ShopRite had a retail fund. I forget the name. I think it was called, I remember the name. And a few, F&B had something called Alpha Code for a while. So some of these corporates have these sorts of internal programs, but for the most part, it's sponsoring accelerators to get access to pipeline.
If you look at because I believe you are one of the pioneers of VC in Africa, especially at the early stage, right? If you look at how the ecosystem has evolved ever since you started, where do you think the most growth has come from, and where do you think we still have a lot of work to do?
Yeah, I mean, most of the growth has come from founders that have, listen, I mean, the ecosystem is a lot more mature today than it was 5 to 10 years ago, but I think most of the growth has come in the fintech space. So people have been doing, fintech, when it first started in, I would say 2013, 2014, with the likes of Paga and Paystack and Flutterwave, etc. It was more just payment processing, and now it's evolved into more nuanced things like asset management, savings and investments, peer-to-peer payments, credit, invoice discounting, blockchain-based applications in the financial services space. So fintech has really evolved. I mean, so that is one thing definitely. What are the I would say the real room for innovation is still very much in brick and mortar industries. What I mean by that is, take for example things like land registry, title deeds. Still, is very much an analog industry. Look at, for example, education. Schooling is still very much analog. You're still going to traditional schools, traditional curriculum, going to university. There's very little digitization in the education industry. The healthcare industry also, I mean, in 2026, we still have physical paper records for patients, right, instead of electronic records. So there are certain industries that are still very traditional and haven't been digitized. I mean, you could say that it took until COVID in 2020 for us to digitize food and grocery deliveries, right? Before that, it was still pretty much not something. People would still go to retail stores and shop and buy food and groceries and all that. So I think necessity is the mother of not just invention, but innovation. And I think that's where a lot of room for improvement exists.
With regards to your portfolio, you invest in startups across the continent, and there's a saying that although Africa is big, at the end of the day there are 54 countries, right? So how do you encourage your startup to think of growth and like expansion? Because I imagine that trying to expand, if you're a company in, say, like in Botswana, and you're trying to expand to either to East or West Africa, is quite a challenge from like a regulatory point of view. How do you like encourage your startups to think of this, to think of scale across Africa?
Yeah, listen, I mean, I understand the challenge that smaller geographies like Botswana, Zambia, Zimbabwe, Malawi, etc. have. Like venture capital funds typically want to back founders that have a very large addressable market. So when you come from a smaller country with a smaller population, unless your business model is really scalable into multiple countries and therefore multiple sort of jurisdictions and users, it's very hard for a VC to look at it seriously, because it's just very hard to scale businesses that don't have the ability to get to $5 to $10 million of annual recurring revenue within their seed phase, so before their Series A. So what I suggest to a lot of people is, if you happen to be building something in a small market, so by the way, the reverse is not true. A lot of South African startups are able to expand into Botswana, Zimbabwe, Zambia, Namibia fairly easy because of the banking system, the insurance system, the retail system. I mean, look at Botswana. Who are the big banks in Botswana? It's FNB, it's ABSA, it's all South African banks, right? Who are the big insurance companies? It's Sanlam, Metropolitan. So it's, again, big South African insurance. You have a similar dynamic in East Africa, right? All the big Kenyan telcos, the banks are present in the other neighboring East African countries. So it's easier to scale from a larger market that has a very active, digitally active, and also from a pure size perspective, a big addressable market. You can then use your relationship with these telcos and banks and insurance companies to expand to smaller markets. However, the opposite is a lot harder. If you're starting a business in Algeria and expecting to scale into Egypt, or if you're starting in Botswana and want to expand to South Africa, you really need to have very niche technology, very strong distribution, and the ability to scale your product offering through these networks of corporates without having to compromise on costs. So it is a lot harder to build businesses from a smaller market expanding into a larger market than vice versa. That being said, when you work in smaller markets, you tend to have higher margins and a higher conversion rates, higher take rates, because there's less competition, right? In Botswana, one of our top investments is Alpha Direct. I'm sure you know Alpha Direct, the big digital platform for motor insurance and now medical insurance. If this was South Africa, you'd spend significantly more time expanding and getting traction. But here, in with Alpha Direct's case in Botswana, it was just signing up contracts with the big retailers like Choppies, ShopRite, etc. So there is a benefit to starting small. You have better margins, better unit economics, but it takes time to scale. And I think that's the important thing that founders need to be aware of.
With regards to VC, like in Africa, there's this conversation. Well, it's a question that like I usually hear, like in podcasts, in like panels, that, is VC working in Africa? And, the point that like people tend to make is that, is it creating enough jobs, etc., etc. I was listening to a podcast of yours when I was doing the research for our conversation, and you stated just the amount of jobs that your portfolio companies have created over the years, right? So take me through that, right? What role do startups have in beyond just providing returns to investors, but also like creating jobs?
Yeah, listen, I think what's really important to analyze here is how many jobs do the companies that VCs invest in create? So VCs cannot basically say, oh, that we created all these direct jobs, but we have contributed with our capital to the creation of all these jobs through our portfolio companies. So I think what you really should be measuring is, as a function of the amount of capital deployed, how many jobs have been created. That ratio is important, because otherwise, large corporates can say, oh, we created 1,000 new jobs this year. But how much capital has actually gone into these corporates? I mean, you're talking like hundreds of millions of dollars if you're a big corporate, right? So what you really should be measuring is, what is the capital efficiency in terms of amount of capital invested into a company, and how many jobs does that company create? From that perspective, VC has the ability to create much more jobs than any other industry, because the utilization factor of that capital is much higher. Secondly, most jobs that VC-backed companies create tend to create jobs in industry, jobs around accounting, marketing, dev, design, operations, sales. So it's mostly skilled, high-quality jobs. Now, there are some jobs that are, you would call, gig jobs, right? Because if you're in for example, the logistics industry or the marketplace industry, you're creating jobs for drivers, for people that do deliveries, etc. So there is a certain amount of what we call gig work, but even that is a semi-skilled job, right? So I would say that because most VC funds in Africa only back tech and tech-enabled companies, the quality of jobs that are created it tends to be much higher. And secondly, the jobs are more sustainable and scalable. And then finally, the amount of capital that needs to go into these companies is much less than when a government or a company needs to create these jobs. I don't think there's any other industry, not just in Africa, but in the world, I would think, where the efficiency of quality jobs created as a function of capital deployed into it is, you won't find that ratio as high anywhere else except in venture-backed companies.
If you look at your portfolio, right, a majority of the startup that you have backed, both with Fund 1 and Fund 2, has been either B2B or B2C2B, right? How do you think of this, right? Why do you back these startups compared to B2C? And, how do you intend to change as the purchasing power of consumers improve in Africa?
Yeah, it's a good question. Yeah, we started off with B2B simply because it was the low-hanging fruit. It's the predictability of your revenue and your income is a lot higher when your counterparty to a deal is a telco or insurer or a bank, because it doesn't matter if you are in Morocco or South Africa or Rwanda. If your counterparty is an eco bank or an Orange, it doesn't matter. They will always pay if you add value to them or their clients. So going down the going down the B2B or the B2B to C route is a lot more reliable and also you can it's a lot more predictable from a revenue perspective. Naturally, people want to have less risk averse businesses, and when your counterparty is a bank, an insurer, or telco, there's more predictability and line of sight into that revenue, right? Now, as you made a very good point, as consumer purchasing power increases across Africa, you will then eventually pivot into more B2C and B2B2C businesses. Sorry, in B2C, and you'll pivot more from B2B2C to B2C businesses, right? So, for example, you would see the likes of Huda, for example, in Nigeria is almost entirely B2C, right? Money Point used to be B2B. Now there's a B2C element to it. So a lot of the larger fintechs are starting to do second lines of businesses where they are working directly with consumers. The benefit of working with consumers versus enterprises is we don't have to give up margins and revenue share with the telcos or the banks. You can do that directly to consumers. So you have a larger share of the consumer's wallet, you have better unit economics, and in theory, an active, engaged, digitally native consumer base is able to help you grow and scale a lot quicker than if you just work with corporates. Number two, B2B, although more reliable, takes longer to close. You can sometimes wait up to 6 months to a year for a corporate to give you a commercial contract, right? And they will maybe do 1 or 2 year letters of intent or letters of engagement. A lot of corporates will not work with you if you are also working with other, what they would consider competitors. So if you have, let's say, a very interesting fintech solution, let's say it's an invoice discounting solution, and you're working with, let's say, FNB and NetBank, chances are that another bank doesn't want to also have, a competitor's service provider working for them. I mean, there are issues around compliance and safety and protection of information and all that. So moving to a B2C business model when consumer purchasing power increases is the natural next step. And this is quite common, right? In markets like India, Southeast Asia, Latin America, initial businesses that did well were B2B, and then as time evolves and the population is more digitally savvy and active, then you start seeing more B2C businesses thrive. Africa is at a point where it's sort of slowly moving to B2C, but it's very slow and very gradual. So we as a fund, we definitely have a few more B2C businesses in Fund 2 versus Fund 1, but it's still, we have to be cautious about how much we venture into that realm.
Now, I want to speak on the economics of running a VC fund. Your Fund 1, you raised, I believe, from 200 or so LPs. What can you share about that process of trying to raise a fund for startups in Africa? How is that process? How long does it take? And what challenges do you come across?
Yeah, listen, raising a fund is not, let me put it this way, is not for sissies. Huh? It's long, hard work, often without much reward, or the rewards come much later. So if you're engaging primarily with DFIs, which most fund managers do, you typically need to be aware of all their requirements, and DFIs can be quite laborious in terms of their requirements, in the sense that a lot of DFIs will require that you have very strict ESG reporting policies. You have a very clear mandate about what investments you can and cannot do. DFIs will require you to have board seats. They may sometimes ask you to have veto rights. It's quite cumbersome, the requirements that a DFI typically has. So my advice to fund managers would be, if you are engaging with DFIs, just prepare and be positioned to deal with a lot of administrative work that may divert you or take you off the path of what you really wanted to do. We chose a different path. We started approaching individuals, family offices, fund of funds, a few CVCs, but it was the bread and butter of our fund has always been individuals and family offices all over the world. So we have much smaller checks. I know in Fund One, our minimum check was $25,000. We actually had a couple of $10,000 checks also, which was crazy. Yeah, which is quite low. And in Fund Two, although our legal minimum is $100,000, we have a small allocation where friends and family can invest as little as $25,000 to $50,000. So we have a lot of LPs, lot like in terms of just a sheer number. In Fund One, we had 236 LPs. In Fund Two, we already have, I think, if I'm not mistaken, about 170 LPs already. So it's quite a lot of onboarding. One of the challenges you have to be aware of is you have to also know the art of, or understand the art of being able to communicate with LPs, especially if you're dealing with individuals and family offices. As long as your communication with them is direct and consistent. So I would suggest quarterly comms, right? Every quarter, send reports to your LPs as to how your fund is performing. Every 6 months, do a proper portfolio report. We as a fund have a policy where we share all our co-investment opportunities with our LPs. We don't charge any fees or carry on co-investments. So there's a lot of transparency. So we send our LPs all these co-investment opportunities often. We don't charge them any fees or carries. So it's about over-communicating with your LPs. So you don't want them to hear about things that are happening in your fund from a third party. So as long as you communicate often and whatever, LPs are reasonable people. As long as you are able to show a clear path towards how they can generate returns by investing in your fund, a lot of fund managers don't have a very clear exit strategy as to how they can realize returns. People assume that once you raise money from LPs, you deploy it, and then you just have to sit back on your laurels. No, that's not how it works, right? So you need to have a very clear path and strategy as to how you return capital to your LPs, and then it becomes a lot easier.
Still on the conversation of the returns, on Fund One, you raised 36 million. You invested, and then you invested in 133 startups, right? And then the total amount that you invested was 31 million. How were the returns from that fund? What did you learn about, your ability to be able to return capital to your LPs, especially considering the fact that you had 200 plus of the LPs?
In terms of having a lot of LPs, returning capital to them becomes a administrative, I wouldn't say a burden, but it becomes administratively quite complex to do distributions to 200 plus LPs, but it needs to be done. But I think because the majority of our investors are individuals, so retail LPs, we have to prioritize DPI, so distributions, and liquidity more than just IRR, right? So we do the vast majority of our exits through secondaries. So typically when we back them at seed and pre-Series A, within 2 to 3 years, once they finish their Series A, and then often once they get to Series B, we look at taking money off the table, right? So we typically sell our stake, and we don't sell our entire stake. We have done it in 3 or 4 occasions, but often we'll do a partial sale. And to avoid dilution and too much of a discount, it is often easier if you can sell your safe note or your convertible note prior to conversion. So if a startup is doing a big Series A round, before your convertible note or your safe note converts to equity, if you're able to sell the safe note, so think of it as like selling an option before exercising it, right? That's how I would look at. So we are one of the few funds that actually pioneered the art of selling a convertible instrument or a safe note prior to conversion. So in that way, you can get better liquidity earlier and also at better terms. Yeah, I mean, I would say that is one of the most important things, is having a very clear, and then how do you segment your portfolio into the really good companies that can return your fund, to the second quintile or quartile that are doing sort of between 2x and 5x. So where can I do partial exits of these companies to get some return? And then you have sort of like your average companies that are maybe doing between a 1x and 3x, and you need to figure out how you can get out of these companies as quickly as possible, but also offer enough upside to a subset of your investors. And then lastly, the companies that are your absolute underperformers, you got to figure out how can I at least get half my capital back or my capital back by securitizing assets and selling it to either private equity firms or angel syndicates that want to be able to buy assets at relatively cheap prices. In Fund 2, we've done a few late stage secondaries where we've bought assets from angels of unicorn companies, but at very deep discounts. So that is something that we should be doing ourselves also, but on the sell side, not just the buy side.
What kind of returns are, like LPs looking at? Is it more like 5x, 10x, or is it more on the region of like 10x to 30x somewhere there?
Most funds, even in the US, don't return. I mean, I was reading a chart the other day. The average US fund that had its vintage year in 2020, which was the vintage year of our first fund, by now, which is year 6, they're only returning about 8% of the fund. 8% on average, right? So to even get to 1x DPI, which is paying all your capital back to investors, will typically only happen in year 9 or year 10. And then beyond that, you have whatever the upside is. So yeah, I mean, a fund that can return 2 times or 3 times capital is an exceptional fund. There are very few funds that can have those kind of returns. So where LPs can really make money is through co-investments. So they'll make some money on the fund side, but they'll make even more money on co-investments. So they get the same terms as the fund gets. They don't have to do any DD themselves. I mean, they should be doing some DD themselves, but most of the DD is done by the fund managers. And they basically like set up either SPVs or sidecar vehicles, or just go directly in the cap table, and they invest alongside the fund into really good companies, and they get very good pricing. So that's where LPs can make up for the, because in a fund you have to pay 2% management fees, 20% carry, which is not a lot, but it can erode your returns a little bit. But on the co-investments, you can easily make up for that.
Over the course of Fund 1, I think you mentioned that the failure rate of your portfolio startups was around 16%. What's your thesis for investing in startups? Do you back the product, the team, or the founders?
It's a very good question. I mean, a bit of all three, but I would say the primary thing we back are the founders, because most founders, they pivot their business model into different products within a year or 2 years of starting. I mean, there are so many examples. In fact, most modern tech companies are selling products that they did not sell when they started off. So ultimately, you want to back the founders first, the product maybe third, and the second is really the actual market that they're targeting. So what is your addressable market? Like, that's where I would say most of the focus should be, but which is also why second and third time founders get a lot more airtime than first time founders. And I think Africa tech is sufficiently old. Well, when I say old, I mean sufficiently evolved, where you have, founders like Shola from Paystack, or GB from Flutterwave, or Ham from Chipper, and Bosun from MoneyPoint, who have the experience now of running companies and are now moving on, or Karim Begir from InstaDeep, or Karim Joueni from Expensia, who's now running Thundercode.ai. I think there's enough time has passed for people to run their first businesses and are now launching second and third time businesses. And it's always easy to back second time founders or third time founders and to back first time founders.
As we close off our conversation, right, you came from a job like in investment banking in the US to come and like do VC, like in Africa. For people who still have that picture, like of Africa, that's quite, like a thing like in the West where it's wars, etc., etc. What opportunities can you share about the potential for growth of, of entrepreneurship in Africa? If you look at the macro, if you look at the innovation, etc., what can you share on what the future of the continent is?
Yeah, listen, I think the one thing I would be very positive about is the fact that you're now seeing really good tech innovation come out of second and third tier markets. I mean, if you look at one of the top super apps in the continent, it's a super app called Gozem, which is in Benin, Togo, Gabon, Cameroon, and Congo Brazzaville. These are countries that most people don't even know where they are on a map. And it's coming out of French-speaking Central and West Africa, right? There's some incredible innovation that we're seeing coming out of Algeria, out of Sudan, out of Zimbabwe, Zambia. So the good thing is basic digital services in education, in healthcare, in logistics, in financial inclusion are now not just a nice to have, they're a must have, right? If you look at, for example, remittances, almost every country in Africa, from the poorest to the richest, has some penetration of stable coins and blockchain-based money transfers, right? Even Malawi, recently I saw a few deals where people were trying to build like Luno or Valor equivalents in Malawi to enable remittances through Bitcoin, Ethereum, or more realistically stable coin transfers. So there are a lot of like digital first and digital native apps that are being built, even in second, third, and fourth tier countries in Africa. So the opportunity for founders to build products in their home markets has never been more than it is right now. And with the spread of AI, it is easy to build platforms in any part of Africa without having to be close to a hub or close to a distribution center or close to. I mean, you can. The beauty is you can build B2C platforms now without necessarily having to go down the B2B2C route today, because the biggest cost used to be the cost of tech and development and design. And to a lesser extent, marketing. Now those costs have shrunk dramatically. So if you have and plus because of the very low cost of data, most people, even in very sort of less developed countries in Africa, are able to access Meta, Google, Amazon, and various channels at a fraction of what it would have cost them as little as 10 years ago. You can build interesting products and platforms even in second and third tier countries. So that to me is a very encouraging sign. We ourselves as a fund have started making investments in these lesser known jurisdictions. And I would say, secondly, as little as 5 or 6 years ago, this whole idea of offshoring your IP into Delaware or London or Singapore or Dubai was quite a complex thing. Now it's second nature. Everyone does it. So founders have a long history of people before them, a generation before them, paving the way for them so they can build these sorts of companies without too much of reinventing of the wheel. So today, for example, if you want to start in Botswana, for example, if you want to set up an invoice discounting platform for SMEs, there are so many examples of previous companies that have done this in other markets. Setting up a company in Delaware or London is now easy. You set up, what I'm trying to say is there's at least 10 years of data on how tech startups have been built in Africa, that you don't have to just go and read business school books on how to build a startup. You don't have to go and read, 0 to 1 or the hard thing about hard things or read all these books. There are real African founders that have built this in the last 10 years. So taking that playbook and making it work in your country, your region, your product, your sector is a lot easier now than it was as little as 4 or 5 years ago.
As we close off right now, what's the future for Launch Africa? Are you guys planning to move from just being like an early stage investor to, being like a growth stage or late stage investor? Do you have another fund in the works, etc., etc.? What's the future like for you guys?
Yeah, our focus is to continue doing seed stage and pre-series A investing. We want to take on more growth stage companies, but that requires, a different type of skill set, different team. And it's also like we currently have more than 170 companies we have to manage between our two funds. So it's a lot of work that needs to be processed. Yeah, we had thoughts about a mezzanine fund at some point, a debt fund. There were talks about us doing region-specific funds like a Southern Africa fund, a Francophone fund. So there are lots of things in the works. I think eventually Launch Africa as a brand is evolving from a early stage VC into more of an umbrella holding company where we have different types of capital stacks for different types of requirements. So eventually, maybe in the next 5 to 10 years, we will have a part of our fund that does only venture debt, or does revenue-based financing, or does mezzanine, or does late stage. But our bread and butter had to be seed stage investing, and then from there you grow and mature. So I would say products, and then regional specific funds, and then potentially doing growth stage. But for now, we're still busy planning it out. But we want to definitely transition from just early stage VC into different products and regions.
Zach, man, I really, really appreciate your time. It's a pleasure to talk to a person who has been like in the ecosystem since the beginning, and it's great work that you and the team are doing, and I wish you guys all the best in the future.
Thank you, man.